On October 19, 1987, in just one day, the Dow Jones index dropped by more than 22%, and for the first time, the world realized that algorithms could shake the entire financial system. In the fall of 1987, there had been several weeks of selling pressure on the US market, but no one expected Monday, October 19th, to become one of the darkest days in financial history. In a single day, the Dow Jones fell by 22.6% and the S&P dropped by more than 20%. It was the biggest single-day drop Wall Street had ever seen up to that point. The strange thing was there was neither a war going on nor a banking crisis. The answer lay in the algorithms that were supposed to protect investments, but instead they destroyed the market themselves. One of them was portfolio insurance. This system was designed so that if prices started to fall, it would automatically issue more sell orders to insure the portfolio. The problem was that every time the market dropped a little, these algorithms would sell even more, which only made the decline worse. In other words, a vicious cycle of initial decline, more selling, and even steeper drops. On the other hand, the program trading systems were also doing their part. Whenever the algorithms spotted a discrepancy between the futures and stock prices, they would immediately execute large sell orders, which simultaneously dealt a heavy blow to both the futures and stock markets. As a result, the machines kept issuing sell orders one after another, and the market makers could no longer hold their ground. The market entered a vicious cycle as if there was no stop button for it. At this point, all eyes turned to the Federal Reserve. Could it prevent a complete collapse? When the algorithmic sell orders were triggered one after another, the market truly spun out of control. The market makers, whose job was to provide liquidity, could no longer handle the overwhelming volume of orders and pulled back. Nearly 200 stocks were halted on the New York Stock Exchange. The sell queues collapsed like dominoes, and in practice, there were no buyers left on the other side. The traders watched in shock. Everyone was thinking about one question. Now, who could stop this crash? The answer came the next morning. Alan Greenspan, who had only recently been appointed as the chairman of the Federal Reserve, issued a brief statement that would later become one of the most historic phrases in financial markets. The Federal Reserve is prepared to serve as a source of liquidity. This simple sentence acted like a positive shock. The market realized that the central bank was not going to be a bystander. It was set to inject all the necessary liquidity into the system and instruct banks to lend to their customers and keep financing going. Operations began swiftly. Short-term rates dropped and the flow of liquidity started moving through the veins of the markets again. The effects of these actions were seen immediately. Part of Monday's losses were recovered within the same week and short-term confidence returned to the market. The economy did not actually enter a recession, and Black Monday, instead of turning into a banking and credit crisis, became a major warning for reforming regulations and market structures. From this point on, everyone knew that the rules had to change, and it was here that circuit breakers and new reforms came into play. Black Monday caused financial markets to change forever. The most important reform was the introduction of circuit breakers. These are mechanisms that temporarily halt trading when the index drops too much in order to prevent a cycle of intense selling. On the other hand, new regulations were put in place to coordinate between the cash and futures markets so that algorithms could not create additional pressure by selling simultaneously. Trading and settlement infrastructures were also upgraded so that the market could handle higher order volumes, and ultimately, a team called the Plunge Protection Team was formed to enable policymakers to act more quickly and in a more coordinated way during crises. After the Black Monday event of 1987, the world realized that algorithms are not neutral tools. They can increase the speed of the market, but if left unchecked, that same speed can lead to an unprecedented crash. Since that day, safety circuits, coordinated regulations, and new infrastructures have been built to make markets more resilient. Given that today more than 70% of trades are executed by algorithms, is it still possible for another Black Monday to happen? Which financial crisis do you remember that had the greatest impact on your perspective of the market?